you have a practice or are you running a business? Valuation is the ultimate KPI.
Hey there, welcome to another episode of the Modern Financial Advisor, brought to you by Truelytics, the premier transition management, business optimization, and recruiting platform for the wealth management and insurance industries. My name is Mike Langford, and I'm the host of the Modern Financial Advisor podcast. And this week on the show, I'm joined by Scott Wetzel, the CEO of SkyView Partners. SkyView is a boutique investment bank focused exclusively on the needs of independent financial advisors and RIAs. And I think this conversation with Scott is particularly timely as we enter 2020 and the brand new decade ahead of us. You're going to be hearing a lot more about SkyView and their Midlife liquidity program and other financing options that they provide. But you're also going to be hearing a lot more about financing and capital options available to advisors just in general, right? Because when you think about where the industry is, we talk about that great wave of transition all the time at Truelytics. And that's because the average age of a financial advisor right now is about 60 years old. And that means in this next decade to come, there are going to be a lot of retirement. So a lot of transition, a lot of succession planning, and a lot of financing needed to facilitate that. And what I found particularly illuminating in my conversation with Scott is that the recognition from him and the team of what makes not only the advisor and RIA community of business owners unique, but also what makes the relationships with the SkyView network of community banks uniquely suited to serve the space. And I think this is important to you and your business because some of the historic limitations on the individual advisors' businesses and RIAs are gradually being lifted thanks in part to firms like SkyView. It sounds funny when you say it out loud, but for the longest time, the advisory business has been a cash-only business. Banks wouldn't lend to advisors, and other forms of capital were limited unless you grew your firm to truly massive size, right? Your multi-billion-dollar RIA firms they're able to raise capital pretty easily through traditional small business lending or even raising equity financing if they need to. But that really hasn't been available to your average individual financial advisor or a small RIA firm that might have a team of 5 advisors, right? And, as you'll hear Scott describe, another challenge facing the advisor space is that those big box banks, as I mentioned, they're often competing with advisors, right? So over time, it's inevitable that an advisor will lose a client or two to a wealth management team at a big bank. So it feels like the stars have aligned for the model of financing ecosystem that SkyView and others, supported by Truelytics, that these firms are bringing to existence. And it's really, really exciting. So I really look forward to the conversation. I think you're going to dig it. And as always, please make sure that you like and subscribe to the podcast. We're on Apple Podcasts, Google Play, Spotify, Stitcher, wherever you get your podcast jam on. Also, be sure to give the pod a share, comment on social. We're active on LinkedIn, Facebook, and Twitter. You can also send questions to podcast@Truelytics or Mike@Truelytics. Love to hear from you. Suggestions for the show, questions about this particular episode, or suggestions for guests. Maybe that guest is you. It'd be great to have you on the show. And, now, why don't you go ahead and grab a beverage, sit back, buckle up, and we'll get to the conversation with Scott Wetzel. Well, Scott, thank you so very much for making time to join us on the show today. I really appreciate you here. So, thanks. Welcome.
I appreciate being on the show today. Thanks for having me.
So before we dive in, I really kind of need to tell you a little bit of a story about my fondness for the name SkyView. I grew up in a town called Brockton, Massachusetts. It's a small city about 18 miles or so south of Boston. And one of the very early airports in the Northeast was in Brockton, Mass. And eventually it stopped being an airport and it was turned into the SkyView Drive-In. And I used to go to that SkyView Drive-In theater when I was a kid. It's where I saw lots of movies, like the original Star Wars came out and I saw it there first. So it's kind of always had a fond name convention in my head for the name SkyView.
Mike, I'm seeing a branding opportunity if the SkyView Theater is still open. I don't know that it is. I don't know if any drive-ins out there. I mean, you're kind of dating yourself here this morning, but that's okay.
I am. I know exactly. Child of the '70s and '80s. It's really kind of funny. They all. I think the drive-ins were all gone by the time the '90s rolled around. For the most part, you could find a couple, but yeah, they were a thing of the past. And unfortunately, my beloved Skyview Drive-In is no more. I think it's like senior living or something like that there on the lot.
Oh, that's unfortunate because I actually know a senior from out there. He's on our staff, so it all is coming together now.
That's great. Well, anyway, I'm super excited. Terry Mullen put us together. He said you'd be fantastic to have on the show, not just because he thought you were great, but the stuff that you're doing at Skyview is really important for the industry at the moment. So I thought that'd be a great place to kick things off by exploring why the type of capital Skyview provides is important, right? Because we've had other people on the show talking about other things, capital related, but in my mind, from the stuff that I've reviewed that you sent over, Skyview is fairly unique. So maybe kind of give us a little bit of background about Skyview, but also, the solution you're providing.
Yeah, certainly appreciate that. And we are unique, yet I need to pay homage to Live Oak Bank. Live Oak Bank initiated funding wealth management industry loans in 2013 in an SBA structure when, candidly, no other bank in the country would touch our industry, and really did not recognize enterprise value for a wealth management practice. So until 2013, roughly 2% of independent and registered investment advisors actually experienced a liquidity event at retirement. And that was commonly done through a seller note. Live Oak Bank came along with SBA structure, started funding, funded about 750 million to date. And to Steve Jobs' credit, he said that great innovators don't copy good ideas; they steal them. So we saw a great idea and what Live Oak was doing, and with our experience in the wealth management industry, we added our expertise around what makes a solid credit in wealth management, but also our expertise around understanding the distribution mechanism in the industry and what advisors expect from a service standpoint. As a result, we have 30 plus external wholesalers throughout the country and an internal sales desk. So it's always a white glove experience through the entire process at Skyview. And to your final question, we're providing capital for mergers, acquisitions, successions, refinances. We're adding a new program for a cash out we're really excited about, but really trying to provide liquidity to a market where there's very, very little liquidity today in the marketplace. And I think Investment News should be coming out with a piece fairly quickly that I believe it's less than 17% of all transactions received any bank financing.
Wow. Why do you think that is? I'm very curious about just this concept of why banks traditionally have had a challenge with this space. Because to me, as I think about, the wealth management space and frankly, the business model, to me, I mean, because, the only thing I can think of is, they don't have assets generally in terms of, form of machinery or buildings or what have you. But if you think about the business model, it is a recurring revenue stream and it's very predictable. And you can look at it historically and get a really good feel for how stable it is. Why do you feel that traditional lenders have shied away from the space? Or is it just an oversight, or is it they can't quite grok it?
Well, to your first point, we hear a collateral airball quite frequently, and I've been thrown out of more boardrooms at banks than I can count that
Mhm.
just struggle with the collateral because it's not tangible. That banks like to feel that they can repossess something and go sell it, and they want tractors and silos and anything else that they can repossess in the event that things don't work out. So first and foremost, collateral is a problem. But then there are other industries that they do cash flow lending for, and it's insurance is a great example, dental. But there's also nominal tangible assets. But the problem the banks still had with wealth management until about 2016 is that most wealth advisors were doing most of their business on a transaction basis. Therefore, if you went to your local bank and you showed them your revenues, one year you had a fantastic year and were way up. The next year you were 30% down, and there was no correlation and no consistency in that revenue. I can tell you that the Department of Labor did us all a huge favor, and for a couple of reasons, it forced many advisors to fee-based accounts, creating recurring, very predictable revenue streams. As a result, we can bring those credits that have our policy calls for at least 60% recurring fee-based revenue to banks and show them a very predictable revenue stream and a diversified portfolio that in the event the market does correct to 42% again, that the advisor is managing those assets, that revenue in that practice will not reduce by 42%. So yes, as we all know today, it's recurring, predictable revenues, but banks really, although they may have had a wealth management department, that message had not been communicated over to the credit department.
So, you covered a range of different types of financing options, right? Capital supply options. You mentioned M&A and so forth. I wanted to dive into some of the non-M&A financing and why advisors may be looking to work with a firm like SkyView in their business. And so I wonder if you can kind of cover those a little more in depth.
Well, the first thing that we always advise advisors around when it comes to banking is that don't wait until you have a transaction or a prospective seller. Uh, Let us introduce you to one of our banks that's actually in the business of funding advisory loans, and there's only roughly 23 in the country today that are in that business. That currently, if you're doing your banking with Wells Fargo or Bank of America, that's great, but you're probably not getting any service for it, and they're certainly not in the business of funding wealth management industry loans. Rather, you're best served by partnering with one of our community banks today, and whatever that means, deposit, checking, savings, mortgage, because banks like having a relationship with borrowers prior to them extending their hand for financing. So that is a crucial message because in banking, and I'm not certain to the exact numbers on this, but roughly 90% of defaults occur in the first 90 days. That lends to the conclusion that those are fraudulent entities. If you have an operating account open at a bank or business banking account, and they can see cash flows coming in and out over the course of months and years, it substantiates the legitimacy of your organization. And therefore, when you go to extend your hand for financing, it's a different process. It's almost like being an alumni, your parents being an alumni of that university. You're looked at in a different light than you are if you're not banking with them. But then the second part, when you're asking about, then that's addressed really just doing banking business, not necessarily lending. But other transactions would be refinancing.
Mm-hmm.
We refinance a tremendous amount of SBA debt. We save advisors in terms of interest payments well into the six-figure range. SBA financing is a crucial form of financing for when banks are first entering into a vertical. Therefore, it was all SBA all the time to start. And at SkyView, we offer conventional commercial paper. So we can replace that SBA debt with a lower fixed rate and remove liens. And the last one is something we just rolled out more recently, is a cash out transaction, which it's almost like a HELOC on your practice. So if you've built up substantial equity in your practice and have very little debt on your practice, and your practice, let's say, is worth $4 million, and you'd like to take out a loan for $1 million to buy that new home that your spouse would like, we have that optionality available from our banks now. And then you can pay it back over a 7-year term and receive obviously a favorable tax consequence on the liquidity, but also favorable tax consequence on the interest payments as well.
So this is that term that you guys, it's been termed midlife liquidity, right? There was a note that went out or is being prepared to go out to advisors that are both Truelytics and in the SkyView network. And phrasing this as midlife liquidity, right? That if you have a business and you're kind of cash poor, if you want to call it that, or not cash rich enough, and you want to be able to take some of the money out of the business so you can do other things, like you said, maybe buying a home or investing in another business, whatever that may be, you have the ability to, through financing through SkyView, access some of that capital with favorable terms.
Correct, and it does. The banks are a little more conservative with the transaction. It is a newer transaction, therefore, our banks will commonly go up to a loan to value ratio uh, on the enterprise of 60 to 80%, whereas with the cash out, they're looking more for 20 to 33% max, and just not because there's anything wrong or more risky with these transactions. I would actually argue there's less risk because there's no transfer of ownership whatsoever. Yet, banks are newer to this transaction for this industry, but in commercial real estate, it's exceptionally common. And as we all know,
Hmm.
when it comes to home ownership, with HELOCs are exceptionally common. Well, today, if advisors don't want to sell any part of their practice, but would like some liquidity and pay it back over 7 years, we have that option.
Yeah, and for the listeners who may not be familiar with the acronym HELOC, it's home equity line of credit, correct?
Correct. Thank you.
Correct. Yeah, that's okay. Yeah, occasionally somebody might be like, "What does that mean?" I can just hear the googling now while somebody's listening to the show. um, so I spend a lot of time in the startup community. And in fact, I actually host an event here in Austin every March during the South by Southwest Interactive Conference for the fintech and financial services community. We have a lot of startups present. And one of the questions that's always imperative that they answer is why now, right? Why is now the right time for Skyview? I mean, I looked at the deck that you sent over, and you started the firm in 2017 is when it launched. Um, so what about the state of the industry, if you will, inspired you and the team to serve the market at this time? Like, what makes this time the right time?
Well, we looked at the demographic trend, and at the time, the regulatory trend, which was Department of Labor, which we found out went away. But demographics you cannot stop nor change. We're all marching towards the same end. And within the financial advisory community, there is a tremendous number of advisors over the age of 60 headed towards retirement that did not have the option that they have at the wirehouses. At the wirehouse, everybody gets a chance to appreciate a nice liquidity event when they retire, and Merrill or UBS will fund that transaction for the next generation to buy out that senior advisor. And we felt that we wanted to provide the optionality to uh, advisors retiring over the course of the next 3, 5, 10, 15 years to retire in a manner in which they choose, with complete flexibility around how that looks, and also to receive a liquidity event if they like.
It's really smart, and it's very much in line with what we've seen at Truelytics, right? That this great wave of transition is coming because you have somewhere in the neighborhood of 40% of advisors are over 60 years old now, and they are marching very quickly towards retirement, whether that's voluntary or involuntary. And there needs to be some option in place to help them, especially as more and more of them have gone independent or have gone to the RIA model. So, really smart. I think the timing is
Well,
apt.
and we also want to make sure that the message is clear to advisors that by no means do they need to retire and walk away and it's over and be not a part of their practice. If they would like to sell 25% to a junior advisor, 49%, we do a lot of partial sales to get some liquidity now when you might argue that these are favorable prices they might be receiving due to where equity bond markets are at today, and experience some liquidity event and actual transfer of ownership to an internal junior partner or an external partner that we're happy we have many very well qualified buyers in our database to do that transaction and kind of uh, really retire have the retirement glide path that they choose with liquidity. If they want it one time lump sum walk away, that is an option. Or if they'd like to experience it over a 10-year period, that's an option as well. They just dictate to us how they'd like it done, and we find the appropriate bank to fund.
I think that's a really smart and important clarification there, that it's not an all or nothing thing when it comes to transition. and succession planning. It doesn't have to be like, that's it, I'm cashing out and I'm out of here, riding up to the sunset. It absolutely can be that smoother glide path, as you mentioned. I think it's really important for advisors to keep in mind as they approach it.
Well, and the other part is that, again, we work with 23 banks throughout the country, and they all have their own peccadillos, and they all have their own individual credit policies and transactions they like to see and don't like to see. And some favor refinances and internal successions and do not like external purchases. Some really like the partial buyout, as we just discussed. Others are not in favor. And what's important for the advisors working with us, we'll find the right bank to get the transaction funded at the best possible rates, terms, and conditions for our client.
So, kind of building off of this, I mentioned the why now. The next question that usually follows up is why you, right? Why you and your team? So, I'd love to dive into your background a little bit to give the listener a little appreciation for why you and your team are uniquely qualified this, but specifically yourself. Looking at your LinkedIn profile, I see that you have a ton of experience in the wealth management and asset management spaces. I wonder if you wouldn't mind sharing your journey to Skyview. Like, what was your aha moment? And you're like, this is where I'm going, right? Because it looks like it's a bit of a pivot, right? If I think about your experience that at least I can see on your LinkedIn profile, there's a tiny bit of a pivot to Skyview. So I wonder if you might want to share like what makes you and the team, uniquely qualified and how your journey brought you here.
Yeah, thanks. It really goes back to I co-founded the first third-party distributor of what we called hedge funds at the time until that became a dirty word. Now they're alternative investments, and that's been over 17, 18 years ago. And started a like distribution entity and sold that organization and stayed in distribution for the interim of my career and understood distribution within the industry and recognized that there was substantial demand for financing. Actually, we just rolled over $1 billion in applications in under 2 years yesterday for bank financing. But you're absolutely right that essentially, well, let's say that I still have one foot in the wealth management industry, but most of my time is spent in banking today. So that has been a change, but we brought in personnel in to Skyview because we only fund wealth management industry loans that have experience in wealth management, and then we also brought on a credit team that has traditional banking experience because you need both to go hand in hand. Because our banks again have not funded a transaction like this before. Therefore, they're relying on our expertise of what makes a good practice versus a practice that they should not fund to actually fund these transactions. And per Dodd-Frank, they need to rerun all the numbers that we run, but our fundamental analysis is crucial to what they're doing in terms of their comfort level with funding to the industry.
Very interesting. So, what's been the biggest surprise? Like it could be a delightful surprise or a bit of oh my God, I wish I knew this before this I started down this path. What's been the biggest surprise so far to you since you launched Skyview?
I'll start out with the bad news and the good news.
Sure, okay.
I wouldn't really call it bad, but wealth advisors have never had access to financing. They're very sophisticated in many other areas of running portfolio and everything else. Just had no bank financing had never been extended to them. So really, their only experience with lending or borrowing had been their mortgage in essence. So with that, what banks always, well, not always, but commonly referred to wealth advisors was unorganized, candidly. And it's not that the wealth advisors are more unorganized than Bob's Pizza Shop or Gary's car wash, just that they didn't have experience with this process and experience with bringing together all requisite source and closing documents to actually fund a transaction. And that's where we help to educate our applicants. And this is what you're going to need. This is the process that you're going to go through. And these are the things you're going to need to do to get this funded. And then post closing, it's not like a mortgage where you walk away and as long as you make your payment, you never speak to the banker again. With a commercial loan, they want to check in quarterly, semi-annually, or maybe annually to ensure that the business is being run in the same manner it was when you went through underwriting. So that learning curve has been a little bit of a frustration for our banks that may not, get the quarterly or semi-annual financial statements on a timely basis. The advisor comes back to us and says, "Hey, why do they need this stuff? It doesn't make sense," and it's just part and parcel to commercial finance.
Well, that's very cool. So, sounds like you're having a lot of fun and it's been a lot of challenge.
But there's good news too, though.
Oh, let's hear the good
Don't
news.
forget
Yeah.
about the good news. Yes, the good news. So the good news has been, um, on a better note, that really surprised our team, uh, that I would say 80+% of wealth advisors are currently doing their banking with one of the big box banks and receiving very little service. And as we moved their relationship over to one of our community banks, we routinely were in the first 6 months getting calls saying, "Hey, this has been really great. I really enjoy having the cell phone number of someone at the bank that I can call at any time to get service. I never had this at B of A. I'm not trying to pick on B of A or whatever big box bank they were at, that these community banks really appreciate that business and have a similar service commitment to their clients that the wealth advisors do, that it's very personalized, high touch, and you always have someone that's dedicated to your deposit account, your loan, that you can pick up the phone at any time and get a hold of someone directly at the bank who provides you with great service." So that has been an absolutely pleasant surprise for all of us.
Well, and it's funny because that's the promise that advisors frankly make to their clients, right? That I'm an independent advisor and I'm going to give you this white glove service, client, right? That you're probably not going to get if you go with a big box wealth management firm or try to do it yourself. So come work with me and I'm going to make sure that I know everything that's going on in your life, that you can pick up the phone and call me anytime and I'm going to answer your emails and texts or whatever. And here they are suddenly, many of them, as you say, for the first time, getting that same level of service from their bank that they've kind of been promoting to their clients. So it must feel wonderful.
Well, and you think about from the wealth advisor standpoint that their service level, they have a staff and they're providing us very white glove service experience. And then they're doing their banking business with somebody who does not extend the same level of courtesy and service. I would be very frustrated because they're doing their business there. And then when they get partnered with one of our banks, not only are they getting great service, but our banks aren't in the wealth management business. So there will not be a scenario where the bank that they're doing their banking business with would actually compete with them for one of their own clients.
Well, I hadn't thought about that, but that is true. Like all the big box banks that you mentioned, have wealth management arms, and so there absolutely will be a scenario where if you're in business long enough, you're going to lose a client, and it's going to be going to your bank. So it can't feel good.
And, and our network of banks are, 23 banks across the country from Alaska to Virginia, Michigan, Wichita. They're banks that are not household names. Maximum, of total assets of probably 16 billion, all the way down to 800 million, and really niche, very progressive banks that are willing to fund to this industry and be quote unquote progressive relative to their other peer banks.
Very, very cool. Well, this has been really, frankly, illuminating for me. I've learned a ton, and I've enjoyed the conversation. Obviously, I have a feeling that a lot of advisors and executives at RIA firms, and frankly, even executives at broker dealers, are going to want to talk to you or learn more about SkyView. What's the best way for people to learn more about SkyView and also reach out to you individually?
Best way is reach out to our team and our internal sales desk at any time to help answer questions. I'm actually not the best person for them to speak to because my job and really the most difficult challenge that we've had since inception is adding banks.
Hmm.
I need to stay laser focused for the entire ecosystem of financing for the industry on my job, which is going in and uh, to boardrooms, banks across country all week long to try to create more liquidity for our space. My partner Aaron Hassler and Chris Jewett run our advisory side of the business, and I run the banking side. So I'd say they'd be better points of contact for myself for the advisory community. because at the end of the day, they're the ones that can get their M&A. For example, if someone's just looking for a bank to open a relationship with, they're in the best situation to ascertain that particular advisor's needs, to find the appropriate bank, or if they have a pending transaction or they're considering a transaction, they're at the front lines every day actually closing deals.
Perfect. Well, that's great. I'll make sure that I include their, not only a link to the SkyView site, but also links to their profiles as well on the show notes for this episode that will be on Truelytics.com. That way, anybody who's interested can reach out. That'd be awesome. Well, Scott, I really do appreciate you carving out the time today. I know you're a busy man and flying around meeting with all these banks, but I think
Not pleasurable and it's not glamorous. Let me just tell you that they're all. I'll say this: that the banks most interested in this are typically in locations that it's not Los Angeles and Manhattan. Let's just put it that way.
but I'll bet you they have really nice diner scenes in the town that they're at. So that's good.
That's about the only option.
So,
Yes.
so not nightlife, but diner scenes. That's what you got to find the thing that you can be into when you're traveling. That's the way I always look at it. Like, what's the thing
Maybe you're right.
Yeah.
I'll do a coffee table book on dive bars or something like that. I need something. I need some reason.
Well, you know what's funny?
Right.
Like a little kind of aside as we close out here. I've done a lot of travel over the course of my career as well, and you know, always when you go to the big cities, it's fun. You'll find a lot of great stuff to do. But sometimes you go to these places that you've only heard of in the movies or whatever, and you find yourself in this small town. That's where you get like, oh, this was nice, right? So for instance, I remember one time I went to Toledo, Ohio. A couple of things happened there. Number one, I'm not sure if you remember that the TV show MASH, but Colonel Klinger was from Toledo, Ohio, and his favorite team was the Toledo Mud Hens, which was a minor league baseball team. Turns out it's a real team. They're actually there and exist.
Interesting.
So
Interesting.
I got to see that and then got to hang out at this little jazz bar like in Toledo, Ohio. It was a wonderful experience. So sometimes the smaller places have some fun experience as well.
It's the little things. You're right.
Exactly.
I appreciate the advice and I will take it and see what I can find.
Well, perfect. Well, thank you again, Scott. You have a great day.
You as well. Thanks for having me on.
Bye.
Take care.
All right. That was fantastic. Thank you very much to Scott Wetzel for joining us today. And thank you for spending time with me as always. Now, before I let you go, I want to do a little bit of a kind of behind the scenes, the making of the Modern Financial Advisor podcast here, because something happened in this episode that for me just wowed me. And I thought maybe you might get something out of it. So, when I do these podcast episodes with a guest, the way that we structure it is we have a prep call ahead of time. And that kind of sets the tone. We get, I get a little conversational rapport with the guest. If I don't already know the guest, that is. So we'll have a nice little conversational rapport, prep call, maybe a half an hour. Then I'll send over an outline for the show. And it's usually a page or page and a half with some, bolded topic areas with maybe some bullet points underneath. Like, here's some general stuff we want to talk about today for the show so that they can be prepared and they're not kind of caught off guard. But I don't make it so detailed where they come rolling in with a script. I don't want people to feel like they're reading off a script. I want it to sound like a natural conversation. And I often say, I want it to be as if we're sitting across from each other at a bar having a beer, right? That it should feel like a very natural conversation. And so I hope that's coming across from me and whatever guest is on the show. Now, you will hear some common stuff. So it's kind of your repetition type topic. So I often ask what I call the IMDb question. Tell me a little bit about your journey. What brought you to where you are today? And what I try to accomplish with that question is I think it really helps the person connect the dots for you as to what's shaped their thinking and what's made them uniquely qualified to do the thing that they're doing right now, right? What's built up all that stuff, if you will, over time so that they're here on this podcast sharing knowledge, sharing insights, and oftentimes ready to provide some sort of value to you even beyond the conversation that you're listening to. So that question is there kind of by rote, right? It's there every time. Sometimes, though, you'll hear me just throw something in and it just kind of happens. It wasn't on the agenda, if you will, the outline. And this week, I asked the what surprised you question. Now, I use that question a lot in my regular life with people. I'll often ask somebody if I'm interviewing them or just having a networking conversation, or even just frankly, a personal hanging out conversation. Like, oh, what surprised you about that? Like, what happened that you didn't expect? Because what I find happens with that question is it causes the person to sit back a little bit and think, hey, yeah, like I had all this stuff prepared in my head. Now I got to think about like, what wasn't I prepared for? What didn't I see coming? And sometimes that's where the most interesting nuggets come from, right? And so you heard me towards the end of the pod with Scott ask that question. And I was so delighted that I asked that question of him, that what didn't he see coming? And he answered, as you heard, that he did not see the fact that advisors in general are not prepared for the amount of paperwork that's required to not only secure their financing, but also to service their financing. And he didn't say it in a way like, advisors are, not good business people and don't get it. No, he wasn't saying it like that. He was just like, listen, this is something that as a profession, as an industry segment, most of the people working in this space have never had to apply for business financing, have never had to produce the routine, income statement, balance sheet, cash flow statement to a lender to make sure that their business is still operating effectively enough so that loan can stay current, right? Because business loans are different than personal loans, whether it's a mortgage or a credit card or whatever. Like, you actually have to service these things by routinely providing some information to the lender. So it was really, really interesting that that came out, because that was not a prepared question for Scott, and he didn't have any, warning that it was coming. And I was so glad that came up. So a little tip for you: ask people what surprises them about what they're experiencing right now, or what they recently experienced in their lives. You might be surprised yourself by the answers and delighted by what you learned from that. Okay. Hope you had a great day, and I'm looking forward to chatting with you next time on the Modern Financial Advisor podcast. Until then, make sure you do send in your questions and topic suggestions at podcast@truelytics.com or mike@truelytics.com. Love to hear from you. Okay. Have a great day. We'll see you next time on the show. See ya. Bye.